Hey, it's Stuart. I reckon diversification is one of the most overrated ideas with respect to investing. Now, I know that sounds like a crazy comment, so let me explain. There's really three levers you can actually control that are going to determine your long-term investment returns: quality, price, and actually where you invest. And the whole important fact is it's all about the hierarchy of those different three criterias. So let's talk about each of them. Quality is really about the underlying fundamentals of the asset. Is it very scarce? Does it have enduring demand? Is there dependable economic engines? You know, it's all about its attributes. If we're talking about a ETF index, for example, we're talking about consistency of earnings, low borrowings, strong earnings growth, good dividends, these sorts of things. If we're talking about property, it's really about the location of that property and the diversification of the buyer pool. So is there multifaceted demand for buyers of those particular assets in those particular areas? I think we all understand what quality means. The second one is price. Overpaying for even a high quality asset usually leads to below average returns. And so what we can try and do is not buy high quality any price, but buy quality at an attractive price. And that way you're going to get capital growth from two contributors. The first one is the underlying fundamentals of the asset. It's strong, it's good quality, so it's going to deliver capital growth. It's going to be worth more in 10 years than it is today. But then the second contributor from growth is mean reversion, the repricing effect. So if you buy an asset when it's cheap, it'll eventually make its way through mean reversion to reasonable value, or maybe even potentially overvalued, and you'll get that capital uplift. And the third lever is where you invest your money. You know, that's one thing we can control. We can't control markets, but we can control picking a good quality asset, not overpaying for it, and hopefully buying at an attractive price. And then the third and final element is where and how we invest those monies. That's when the diversification bit comes to play out. So with respect to investing in residential property, you know, it's really about allocating your scarcest resource, which is cash flow and borrowing capacity. Buying an asset where it's in very high demand, it's very scarce, hopefully fixed supply. And as I said, that there's a diversified underlying demand. And it's very important to understand who the future buyer for that asset is, because if you want to sell it for twice as much in 10 years, or 4 times as much in 20 years, or 8 times as much in 30 years, which is really about a 7% average capital growth rate, you want to think really carefully who those cohort of buyers will be and how can they afford to pay 4 times more in 20 years. If that cohort is just relying on borrowing capacity and average increase in incomes, it's not going to work. If that cohort has access to other sources of wealth like business, inheritance, employee share ownership plans, these sorts of things, you've got a greater chance of being able to sell that asset for a lot more in 10, 20 or 30 years. If we're talking about investing in the share market, it's about using a rules-based, evidence-based approach. Buy an index that still gives you broad market exposure. Build an ETF portfolio that doesn't take too many really strong active bets, as in, you know, all in the US technology sector or all excluding the US technology sector. You still want to have broad-based exposure. You don't want to move too far away from the traditional market cap index. You know, about 70% is in the US market for good reason. It's a huge economy and it's a huge developed economy. So we don't want to take active bets, but we do want to build a portfolio that allows us to target areas and indexes that have high quality, that are very attractively priced. So the main objection though to this idea is, isn't concentration risky? You know, because I would rather put all my money in just one ETF or one property if it's a high quality asset and I can buy it for a very cheap price. I'd rather put all my money in that because I know in the long run my returns are likely to be above average. But of course, that concentration risk is risky. In the short term, you could have higher volatility. In the short term, you could underperform. But to my mind, it's less risky than just blindly splitting your money across various assets irrespective of price. And I think this is the main theme in today's video, is that price is second in the order between quality, price and diversification, and it's a very, very close second. And it's the core of my rule number 5 in my new book, Wealth by Design, which is to construct a value-aware asset allocation. And to be not value aware, I think, is maybe one of the more risky approaches that we could use. So the book has an AI companion, so hopefully you can learn the principles in the book and then help apply those principles to your personal situation. I've written a short article that sort of compares the differences between Wealth by Design and my previous book, Investopoly. So you might want to check that out. The link is in the comments section. And if you're interested in buying Wealth by Design, of course, the link to Amazon is in the comments section as well. I'll leave it there. Thanks for listening.